to, well, look at what exactly has been happening in that sector. Today, of course, Barclays Bank of Kenya having moved to try and educate its stakeholders on what exactly the new accounting standard IFRS 9 means for them. Now, this, of course, is a subject that has gotten differing reactions from many different stakeholders, especially accounting firms. And one has published a global briefing paper that, of course, is on the new financial instrument, which is expected to be implemented from the 1st of January 2018, and will require banks to show their expected losses earlier than in the past. And they have warned that this approach may make reporting and comparing bank performance more problematic. The paper also says that the new standard may substantially increase the risk, increase the amount banks set aside for bad loans, and also make the results more unpredictable as economic predictions are made. According to that paper by the ICAEW, while the key challenges banks will face include difficulties predicting the future, complexities of calculations, and defining significant changes in credit risk. That, of course, is at the global level. Here in Kenya, it is expected, of course, that some of those challenges will surface when it comes to bank reporting. And to break this down for us and be able to give us a certain perspective on what we can expect going forward, I'm joined by Yusuf Omari. He is Chief Financial Officer and Finance Director at Barclays Kenya. He's joining us from our city center studios. Yusuf, karibu sana. Well, first off, of course, the question on everyone's mind is, there has been a lot of talk about this new standard, IFRS 9. What exactly is it, first, in a nutshell?
Yeah, so IFRS 9 is basically an accounting standard that basically is looking at how we account for financial instruments. And it's basically replacing IAS 39, which is what we had been applying all the way until 31st of this year. And basically what IFRS 9 is doing is reacting to the global financial crisis of 2007, 2008, where we saw quite a number of banks struggling with challenges that faced us at that time. So the key fundamental changes that are coming with IFRS 9 is moving from an incurred basis of providing for impairment to what you call expected. So it's more forward-looking and basically looks at three aspects when you come to predict that. So you're looking at past events, you're looking at current events, and then you're projecting forward to see what will be the impact of credit losses in particular financial instruments.
Now, for a lot of my viewers sitting out there at home, they're saying this is a lot of accounting mambo jumbo. In simple terms, how will this affect me as a stakeholder, either as a shareholder, an investor, a person who runs an SME, or as an individual?
Yeah, so day one, this is 1st of January 2018.
Yes.
We expect banks to now effect IFRS 9. And the expectation, if I was to talk from a perspective of some of our stakeholders, especially the shareholders,
yes,
is that the differential between IFRS 9
yes,
and IAS 39 will
yes,
basically be taken through our reserve. So basically reducing the reserve balances, which is what is available for distribution to our shareholders.
Yes.
Now, from other stakeholders like our customers, of course, when we are looking to lend, and I'm using that as just one of the examples of financial instruments, when we are lending to our customers, we will basically change the way we look at credit losses. In the past, under IAS 39, we were waiting until a trigger for credit losses comes through for us to make a provision. However, with IFRS 9,
and just to cut you off right there,
we're actually taking a provision on our customers.
Sorry to cut you off, but essentially what you're saying is in the past, you had to wait maybe 3 months to declare a customer maybe bad debt, they're not servicing their loan, that sort of thing. And this time around, you will have to do that even before the loan leaves your books.
Yes, so the day one when we book, a facility,
Yes.
we will definitely look at the probability of default for this facility over the next 12 months. So indeed, we are taking a provision on day one.
Yes, and that is 100% provisioning.
No, so what happens is we will come up with impairment models, and these will cut across, for different banks we'll have different, impairment models based on the experience they've had in the past for different products. So in there, you may be, for argument's sake, taking a 5% provision.
Yes.
I'm just using that as an example.
Yes.
And basically what happens with IFRS 9, we have different stages. We have stage 1, stage 2, and stage 3. So stage 1 basically means it's a good performing book, but you're still taking some element of provision. However, when the deterioration in the economy, or we find some challenges with this facility, then we fast track and move that facility from stage 1 into stage 2. And the minute you move into stage 2, you have a significant increase in provisions for impairment. Of course, by the time you move into to stage 3, then you're literally like writing off that facility. So unlike in the past, under IAS 39, when we used to wait for triggers, this one you're now looking at it forward. It's a more of a forward-looking kind of model.
So then what does this mean for this person who's out there with a small SME that depends on loans or things like overdrafts for its day-to-day running, for its working capital? What does it mean for that kind of person? Is it going to be more expensive to get credit? Is it going to be more difficult?
Yeah, so the big challenge for us really is the fact that in an ideal world, and out there where we don't have interest rate capping, this is a good opportunity for banks to be able to price for risk. Now, the challenge with Kenya, of course, with the interest rate capping, you cannot be able to move beyond, the cap that has been set, by central bank. So what banks will do basically is to make sure that they're driving products that are profitable, and they're basically giving them the necessary returns that banks are targeting. The challenge for us really is not just in terms of the pricing, because we know we have a challenge there, but then also in terms of the collective credit policies that we put into place, including collections where we see a delay in payment from our customers, how we fast track to make sure that this customer does not move from stage 1 to the next stage, stage 2, where significant, provision is made. So that will be the reaction you will see with banks, really looking at their product, looking at their collection strategies, looking at the investments in terms of things like system, to be able to look at things like big data analytics that can be able to predict which customers is more likely to default. So that's the kind of reaction that you'll be able to see coming from the banking industry.
Yes. So finally, for me, the fact of the matter is that today Barclays held, in conjunction, of course, with the Institute of Certified Public Accountants of Kenya, held a forum where they were explaining these things to various stakeholders. Why would Barclays and, of course, their stakeholders go out there to educate the public on this? What's in it for you?
Yeah, I think for us it's really to be responsible in the industry. As Barclays, we started this journey 2 years ago, and as we are speaking right now, we are running parallel runs, both on the old model and the current model. Now, what we need to do is to create this awareness, bring in different stakeholders. We've had ISPAC, which is the Institute of Accountants. We've had CMA, NSC, and tied to that is also to bring our regulator, which is central bank, and have open discussions on the impact of this new standard, and in there be able to come up with our own guidelines in terms of, for example, uniformity of application of some of the credit risk parameters. So just to give you an example, which is a topical issue, in the new standard, we're not just looking at loans, but then we'll also take impairment on sovereign debt. We'll take impairment on our investment in government security. So different banks will apply different rates, but then we need, all the grouping of the key stakeholders to come together and make sure that we can discuss this and come up with uniform applications going forward. Tied to that, of course, we have a regulator who has put some capital ratios for the bank. And of course, on day one, we need to be able to be very clear in terms of, how will we treat this significant increment in impairment vis-a-vis our key, capital ratios. So those are the challenges we are bringing them to the forefront. We still have a few months before, we go live with IFRS 9. And so the more people know about it, the more analysts know about it, the more we engage our regulators, then the better for this industry.
Well, indeed, quite a tough topic of conversation there. Of course, the new accounting standard, IFRS 9, that is expected to come in from the 1st of January. And what exactly its impact on you will be? That, of course, right there is Yusuf Omari. He is Finance Director at Barclays, Kenya, giving us the lowdown on just what to expect once that does get operationalized in a big way starting next year. Indeed, thank you very much for talking to us here. Of course, he's talking to us from our city center studios.